afternoon. Time to check in on the markets. As usual, we start off with things on the Asian side of stuff. And we did see Asian markets lower, taking their lead from what we saw overnight on Wall Street as investors prepare for the Fed's interest rate decision. Locally, as we look at what's going on from a global perspective, markets a little bit lower when we look at global stocks, and in an environment where we're seeing government bonds and the dollar rising. And it's in an environment where investors were already feeling a little bit jittery. And then we had the announcement a little bit earlier on from Russian President Vladimir Putin ordering a partial mobilization of 300,000 troops. That impacting markets, or rather impacting the oil prices at least. When we look at what's happening on the oil trade, when we're taking it from the Asian perspective, oil rising about 3%. European equities also lower. Currencies under fire as well. And as I mentioned, we are preparing for the Fed interest rate announcement, where it's already seemed to be priced in that 75 basis point is in the bag, at least to deal with an inflation that rather seems to be troubling the US economy. But it's also a week where we are seeing central banks, the Bank of Japan, Bank of England, also preparing to announce their interest rate decision tomorrow. We will keep you updated on that and unpack what that means for global markets going forward. But the all-important, crucial part of the Fed's, at least the FOMC statement, as well as the press briefing, will be on economic projections in terms of what the Fed foresees happening to the economy over the next couple of years. But to give us perspective from a markets perspective, we are joined by Chantal Marx from F&B Wealth and Investment. Chantal, thank you so much for your time. So European markets a little bit lower, and this is because, we've got Russian President Vladimir Putin ordering a partial mobilization. How are we looking locally ahead of that all-important Fed meeting?
Yeah, I mean, locally the market is also quite mixed. It's actually on balance negative, but I think that's to be expected on a Wednesday because a lot of companies are trading ex-dividends and a lot of big dividends are actually coming up over the next week. So that is definitely impacting the market. I mean, Tagela, for example, 60 Rand dividends, so that shares down by about as much. And you'll see something similar with some of the bigger names that also declare dividends. Then, of course, we do have the Fed coming up. So everyone's quite scared of making any big moves at the moment. So even those larger moves seem quite tentative. They might be attached to bargain hunting. But yeah, everyone's kind of just waiting and seeing for now.
So as I mentioned, 75 basis point already seems to have been priced in by the market. But what are the key elements that you're going to be paying attention to? I mean, I touched a little bit on those economic projections. Yeah,
I mean, I'm going to be focused on dot plot, because the economic projections are going to be very important. But more important is the Fed members, or the Federal Open Market Committee members' interpretation of that data. And what the dot plot does is it basically asks all the committee members, where do you see interest rates going over the next year or two? And if there are any deviations from what is expected, then we could have a little bit more pain to come if it's going to be higher than what the market is expecting, or perhaps if it's lower than expected, we might get a little bit of reprieve.
It's quite interesting because, I mean, if you look at Bloomberg's analysis and where the market sees the dot plot going into next year, markets for some reason are still buying into this Fed pivot, which I think is dead and gone because you have Chair Powell reiterating that they need to do a lot more and be a lot more aggressive to get inflation back to 2%. So I'm not sure what I should interpret here. I mean, is the market wrong to still believe that a Fed pivot kind of exists?
No, they're not wrong. They might just be wrong in terms of the timing of that Fed pivot. So the Fed pivot is going to come because interest rates will inevitably result in the economy slowing down, inflation coming down. Some of the supply chain bottlenecks that we've been experiencing over the last 2 years will start to dissipate. I guess the spanner in the works is still the situation between Russia and the Ukraine and what that will mean for energy prices. But eventually, if the economy starts softening, interest rates have to start coming down again at some point, especially when you are saying the R word, recession. So I think the market is a little bit confused as to when that pivot will come, perhaps a bit enthusiastic that pivot will come towards the middle of next year. It could be towards the end of next year or even into 2024.
yesterday we spoke about tech stocks with my guests, and I mentioned that we haven't spoken about US tech stocks in a long time. And then you look at what's going on with government bonds, especially in the bond market, whether it's German or etc. What would need to happen in order for, a tech trade of any kind to work? Do we need to see bond yields stop going higher or come back down?
So I think a good start would be for them to stop going higher. So in that sense, then the discount rate that you use to value these stocks, it's all very technical, but it will at least stabilize, and then you can start focusing on things like, what does revenue growth look like? What is profitability going to look like? Where is the growth going to come from? But a real kicker, I think, would be if you start actually seeing those yields come a little bit down, because then the overall value of the stock relative to what the rest of the market is doing will look a lot better.
Right. Speaking of, in terms of where growth is going, revenue growth that is, I mean, you're seeing corporate quite a few warnings. You had Ford yesterday talking about inflation and supply costs, GE, McDonald's, etc. How concerned are you going into the third quarter earnings that we're going to see earnings revisions, going forward?
Yeah, I mean, so for the third quarter, we've already seen quite substantial downward revisions. So if you looked at what was expected for the third quarter earnings season at the start, so in July, 1 July, it was about 10% year-on-year growth. That's come way back down to, as we approach the end of the quarter, to about 3%. I think there is probably still room for disappointment, but in the same breath, there's also, of course, room for a little bit of an upside surprise. Analysts tend to be extremely cautious when it comes to earnings, and they do tend to project something a little bit lower than what usually comes through, particularly in the US. They are extremely conservative. So given that size of the move, I'm not too concerned that corporates are going to miss by a big margin, but you could still see negativity from analysts becoming a little bit antsy as the quarter comes to a close.
I wanted to talk to you about the volatility in the market and what that means for the companies that you do want to hold. Do those characteristics change very much, or are you still sticking to the same characteristics as F&B?
I mean, for us, it doesn't change at all, because we are long-term investors and we look at companies that have quality business models, high and steady cash flows, strong balance sheets. These are the kinds of things that would stand you in good stead during volatile times. You might be called a little bit boring during the good times, but it does work through all the cycles, and we've made absolutely no change in that regard.
All right, let's leave it there. Thank you so much for your time. That is Chantal Marx from F&B Wealth and Investment.